Hello, my name is Lachlan St. Clair and welcome to CSP's first investment update of 2020. Well, as I speak today, share markets are selling off pretty significantly over concerns about the coronavirus, so I suppose that's really where I should be starting this update. I guess the first thing to comment on is, why is corona an investment or an economic issue? Somebody asked me the other day, they said, well, it's a health problem, but what's the economic impact? The issue from an economic perspective is that when you lock down, let's just take Wuhan for an example, which is obviously where this thing started in China. If you lock down a city of 60 million people, you get quite a few economic flow-on consequences. Firstly, you get some short-term consequences in the immediate area. So, for example, I'd imagine the average restaurateur in Wuhan would be struggling somewhat at the moment, given people are not allowed outside. However, in addition to that, people aren't allowed to work. And so when you shut down the industrial components of China, and a lot of other companies around the world rely on Chinese components to go into their manufacturing processes, then that disrupts what we call supply lines. And so as an example, this is precisely what's happened to Hyundai in Korea, where at the beginning of this month, one of their factories was in Wuhan that made, I think it's like a wiring harness for their cars. That factory shut down, and therefore when Hyundai in Korea runs out of the stock that it's got, and nobody in the corporate environment now tries to keep much stock because that costs you money, everything's about just-in-time supply lines. When you run out of that stock, you then need to press stop on the production line. That's effectively what's happened in Korea as an example. So although this has predominantly affected China, because China is really a manufacturing center for so many organizations around the world, then those organizations are now starting to see their supply lines dry up, and that's having flow-on effects for manufacturing globally, really. And in addition to that sort of supply line, more complicated stuff, you get the more simple stuff, like Chinese people can't travel, so tourism starts to dry up, foreign tourists, foreign students in particular in Australia start to dry up. Consumption globally tends to dry up, and so these sort of things obviously sort of flow on into a reduction in GDP and a reduction in confidence as well. So that's really where where it's sort of the rubber hits the road, I suppose, in terms of the economic impact. Why has the market suddenly reacted today? I'm sort of doing this on Monday, about the 26th of February or so. Or the 27th. Why has it suddenly happened today? The issue over the weekend was that up until this point in time, people thought, or the markets assumed, that this would be fundamentally pretty well contained in China. However, there has been outbreaks now in Italy and some significant outbreaks in Europe. And whilst nobody knows, clearly that's a significant development, and the prospects of a more bigger global outbreak have increased significantly off the back of that news. And I think that's really what the market's now suddenly focused on and said, well, hang on a minute, if this isn't just a China thing, this is a global thing, it's going to have global impacts, and therefore we need to start to downgrade some GDP in response to that. On the plus side, one of the only things I can think about, I drive a V8 Land Cruiser, as a lot of you know, and petrol's down to about $1.35, which, given the Australian dollars at 66 cents, which I'll talk about later on, is quite extraordinary. But really the reason that petrol is so cheap is that industrial demand has just dried up with all those industries being turned off, and therefore the price of oil has come down, and therefore the price of petrol has come down. So all these sort of things do tend to have flow-on consequences. So where's it going to end? Look, the reality is nobody in the investment or finance industry has any better insights than what anybody else has, really, of reading health reports and from the World Health Organization and their guidance. I think it's fair to say the prospects of a global pandemic have increased. I don't think I'm saying anything contentious when I say that. And therefore the prospects of a significant GDP contraction have increased. And therefore, as I said before, that's what's led to the share market coming off. Where it's going to stop, I don't know. Nobody knows. And I think, unfortunately, I don't have a crystal ball as much as I wish that I did. And so for the rest of these comments, I'm going to assume that over the next 6 months or so, in 6 months' time, we won't be talking about this any longer. We'll be talking about other issues. US presidential election is an obvious one. And I don't make that comment to belittle the human cost of corona. It's obviously significant, but being an investment update, I'm just going to assume that from an investment perspective, in 6 months' time, it's no longer an issue, and we have tended to move past it. Okay, so from an economic perspective, where are we at, and what's next? And the economics industry is an industry that is, in my view, renowned for providing a lot of noise. There's a huge amount of information, and not that much of it tends to be that relevant, I think, in the fullness of time. So what I've chosen to focus on now are the things that we know, things that aren't contentious and that are facts. And I think there's a couple of those things that we can sort of put in the ground and start to build a case on. The first issue is that we know is that the level to which interest rates recovered after the GFC in the United States were at a far lower level than was generally the consensus even 3 or 4 years ago. The United States and the world had global financial crisis, monetary policy and interest rates reduced to extremely low levels, negative levels in some cases. Generally speaking, though, most people thought they'd come back to around about the 4% mark. That was then downgraded to the 3.5% mark, downgraded again to 3%, downgraded again to 2.5%, and now if we're lucky, we're going to get a 2%, 2 to 2.5% interest rate in the United States as the neutral rate. Now, if you bear in mind that inflation will be running at around 2%-ish, that's effectively a zero real rate of return as the neutral rate of interest going forward. So that's a very low figure, and I'll come back to some of the consequences of that shortly. What it does mean, though, is that for the next downturn, there's not a huge amount of monetary policy ammunition left in the monetary policy gun. So what I mean by that is if the next recession comes along, it's not like reserve banks have got a huge amount of interest rates reduction that they can push in their economies for stimulation. So that's obviously going to hamstring the policy response to the next downturn, but I'll come back to that point shortly. We also know that many countries around the world are running pretty significant deficits and still have pretty significant amounts of debt. And the United States probably stands out materially in that context. Their budget deficit at the moment is about $1 trillion per annum. That's $1 trillion more they're spending than they're taking in tax. And debt levels around the world are really still really quite significant. We also know that unemployment in the United States and the Western world generally, but the United States in particular, is very low. It's probably masking an underemployment problem, but fundamentally unemployment is very low. Unemployment in Australia is very low as well. It's probably a little bit higher in the United States. And we know that for a fact. We also know, importantly, that this significant reduction in interest rates has led to a massive rally in the share market over the last, really 8 years or so, I suppose, since Mario Draghi came out and said, we'll do whatever it takes to save the euro. We've had a monumental rise in equity markets. Pretty much all growth assets actually have increased significantly off the back of those interest rates being pushed down really low. And I think that's a statement of fact I don't think anybody can really disagree with. Finally, what we also know is that if inflation breaks out, and that is by no means a foregone conclusion, but if inflation breaks out and interest rates rise, or more importantly, US long-term bond yields start to rise, then all bets are off in the valuation of growth assets. That's fancy investment speak for saying the share market is likely to get smashed. 20, 30, 40% is not to be unexpected if that significant inflation breaks out and if that's accompanied by a significant increase in the US 10-year bond yield. I don't think there's anything there that anyone could say is particularly contentious. So from this we can surmise two things. Firstly, that the Western world's ability to respond to an economic downturn is rather limited. Where are we going to get the next round of stimulus from? We can't really reduce interest rates. They're already down. Very difficult for the US, as an example, to spend more money. It's already running a $1 trillion deficit. Unemployment's already extremely low. Where do you get your next push from? So really quite a difficult environment for the Western world in particular when we face the next economic downturn. And we've attached in the section below this video an interesting paper from Bridgewater Economics who provide their next 10 years economic outlook, and they really sort of jump into this issue, I should say, in a bit more detail, and that is definitely worth having a read of. Secondly, the expectation of future returns, both on defensive assets, i.e. bonds, and growth assets, i.e. shares, are very low going forward. I mentioned before the US 10-year bond yield expected to sort of settle, US 10 interest rates, I should say, should settle at around about 2%. The bond yield's not going to be that much more. Share market has had a big rally due to that reduction in interest rates. They can't really go any further, much further, touch wood, much lower, and therefore the growth in future share markets is not expected to be anywhere near what it has been over the course of the last 10 years or so. So much more muted returns over the next decade than over the last decade, and in a far more fragile state from an economic perspective in the Western world. Hamish Douglas, who works at Magellan, who I'm sure most of you would recognise the name, has put forward the possible economic scenarios and their attendant probabilities. I think this is really good in terms of just framing where things may go moving forward. Scenario one is we just tend to bumble along sideways. The economy doesn't take off, it doesn't contract materially, interest rates don't really go anywhere. It's just this long, slow grind that's really sort of happened over the last couple of years. The probability of that, he puts it about 50%. Don't quote him exactly on the number, it's the magnitude that sort of matters. From a stock market perspective, the impact on that's really pretty limited. I think that's sort of that previous comment I made about low growth. That's probably really assuming that economic scenario comes to fruition. The second scenario he puts forth is an economic downturn, a significant, like a recession, followed by rate cutting. Not there's a huge amount of rates yet to go, but there could be significant. So there could be some additional rate cuts, I should say. And if we go into monetary policy version 3, which is as per the Bridgewater paper, then that's really where sort of interest rates could ultimately go. The impact of the stock market on that's quite hard to gauge. Because although earnings may come down, if interest rates go down, then multiples may go up. So the net impact on the stock market may actually be pretty neutral on that one. And Hamish puts the probability there at around about the 30%-ish mark. If I were to dare to second guess Hamish, I would imagine that in light of coronavirus, the prospects of that 30% are probably increasing a little bit, given the potential impacts of corona on the global economy. The final probability or the final economic scenario is a significant breakout of inflation, and with that, a significant increase in interest rates. Hamish puts the probability of that at 20%, and again, daring to put words in his mouth, I would imagine that would be falling in a post-corona world or with the coronavirus around at the moment. The impact on that, though, would be significant on the share markets. That's where that scenario I mentioned before, where we could see the share market coming off 30 to 40% or so, without too many probabilities or without too much conjecture. From the Australian domestic perspective, we've obviously been hit by bushfires. They hit us pretty heavily, and the coronavirus is also going to have a fairly direct impact on our economy, really due to our direct ties to China. I mean, there's such a big part of our export market at the moment. If China slows down, we're going to slow down as well. I don't think there's any real doubt about that. In addition to that, our economy is weaker than the United States. Our PMI, our manufacturing index data, is lower. Our business sentiment and consumer sentiment, or business confidence and consumer sentiment, I should say, is low and falling. Retail sales have fallen off a cliff, as I'm sure many of you know. Unemployment's starting to tweak up, and real wages growth is starting to roll over. So, from a domestic perspective, economically, Australia is not looking that great from a data perspective. The good news for Australia is that some of those weaknesses I mentioned before in the Western world, we're in a slightly better position. Our government doesn't have a huge amount of debt by Western standards. Our federal budget is in a pretty reasonable position. So if the federal government does decide to spend money with fiscal policy, then it's certainly got the capability to do so. And most importantly, the Aussie dollar is doing again what it has been doing since the mid-1980s and really taking the hit for us. With that Aussie dollar falling right down to 66 cents now, that makes our exports more competitive and does tend to cushion the impact on the domestic economy here. So Aussie economy's taken a bit of a hit, and it's probably not quite as strong a position as the United States, but strategically over the medium term, it's got a bit more going for it, I think, in terms of monetary policy levers, or policy levers, I suppose, more generally. From a portfolio construction perspective, obviously for our retirement portfolios, we took a reduced position in growth assets about 12 months ago. And the reason for this was because we had those lower return expectations moving forward. Our modelling was showing us that we weren't really getting much of a benefit in terms of portfolio longevity for taking all that growth asset risk. And what we could also show was by reducing the growth asset exposure by sort of 30% in many cases, we weren't really getting a particularly significant reduction in portfolio longevity. And therefore, if you're not being rewarded for taking the risk, as financial advisors, our question is, why would you take it? And so that has led to a not insignificant reduction in portfolio risk that we took across most of our clients' portfolios over the last 12 months. We're certainly not looking to unwind that position at the moment. The future forecast returns are still quite low. Clearly, if there is an economic shock in some way, shape or form, or a share market shock, I should say, and maybe Corona will provide that, maybe it won't, I don't know. But if the market comes off 10, 20, 30% or so, then we'd probably be looking to undo that trade because we would be expecting some materially stronger returns going forward. But at this point in time, we're happy to sit tight with that strategic positioning. We also reduced our weighting to United States equities quite significantly over the last 2 years, as that market's been getting higher and higher and higher. And we're certainly happy with that position as well. The US equity market on a lot of metrics, not all metrics, but a lot of metrics, looks seriously overvalued. And so based on that, that's kind of the time to start reducing your position in those assets moving forward. So anyway, that's it for me for this edition of CSP Smart Money. We've seen many clients. For those of you whom we have not seen, we look forward to catching up over the next couple of months. And of course, if you've got any specific queries on your portfolio, you're always welcome to give the office a buzz. But for now, we'll talk to you soon. Goodbye.